Welcome to Spidell's California Minute. I'm your host, Catherine Zidane. This week we're covering federal and California law changes that taxpayers need to consider when deciding whether to make the June 15th pass-through entity tax prepayment. Spidell's post-tax season update and review webinar covers answers to all the questions that come up during tax season, like Trump accounts, the new qualified tips and overtime deductions, qualified opportunity zones, and more. Get registered for one of 4 dates in May at spidell.com under webinars. As a result of changes made by OBBBA and California SB 132, taxpayers and their tax professionals have new factors to consider in evaluating whether it makes sense to make a pass-through entity tax election for 2026. While OBBBA did not make any changes that directly impact California's pass-through entity tax, it did increase the SALT limitation from $10,000 to $40,000. The deduction is phased down, but not below $10,000 for taxpayers whose AGI exceeds $500,000. Taxpayers whose AGI exceeds $600,000 can only claim a $10,000 SALT deduction. For married filing separate taxpayers, the $40,000 limitation is reduced to $20,000 with a lower phase-out range. A question taxpayers have to answer is whether it still makes sense to make the election given the increased SALT limitation. After all, the pass-through entity tax was enacted as a workaround to the $10,000 SALT limitation. For most taxpayers, making the election still makes sense. Even for clients whose income is low enough to claim their full SALT deduction, state taxes paid by the pass-through entity are deductible as a non-separately stated deduction for the pass-through entity, which has the effect of reducing the pass-through owner's adjusted gross income. Any deductions that reduce adjusted gross income are beneficial because of the sheer volume of tax attributes and phase-outs that are based on AGI. Under California's pass-through entity tax regime, taxpayers are required to make a prepayment of the tax by June 15th of the current year. The prepayment is equal to the greater of $1,000 or 50% of the pass-through entity tax due for the prior year. Prior to the 2026 tax year, if a taxpayer failed to meet this requirement because they made the payment late or underpaid the amount due, they were ineligible to make the election for that tax year. This was true even if the taxpayer had reasonable cause or only underpaid the prepayment amount by a minimal amount. As a result of the changes made by SB 132, beginning with the 2026 tax year, taxpayers can still make the election. However, the amount of credit that the owners can claim on their California return is reduced by 12.5% of the amount underpaid by the June 15th prepayment date. If the taxpayer misses the June 15th deadline, they should consider whether it makes sense to make the payment as soon as they discover that the payment was late or wait until the original due date of the entity's return to make the election. The 12.5% reduction applies whether the payment is made on June 16th or March 15th. We cover this topic in more detail in the May 2026 issue of Spidell's California Tax Letter, including a discussion on modeling whether to make the prepayment for taxpayers who missed the payment deadline or only underpaid by a small amount, including a comprehensive example. For details on a subscription, go to spidell.com and click Publications. That's all for this week. Join us next time for another episode of Spidell's California Minute.